You work at a small business. Your employer doesn't offer a 401k. They offer something called a SIMPLE IRA. And you're over 50, maybe closer to 60, trying to catch up on retirement savings as fast as you legally can. So you Google the 2026 catch-up contribution limit, you see $7,500, and you think that's your number. It probably isn't. The SIMPLE IRA runs on a completely separate set of rules with its own limit. And in 2026, thanks to Secure 2.0, there's also a super catch-up available between ages 60 and 63 that almost nobody with a SIMPLE IRA even knows they might qualify for. According to the IRS, roughly 600,000 small employers use SIMPLE IRAs to cover their workers, which means there are millions of people sitting at this exact crossroads right now. The question is, which limit actually applies to you? And are you leaving money on the table because nobody explained the difference? Let me back up for a second and explain why SIMPLE IRAs even exist, because I think most people don't actually know why their employer chose this plan over a 401k, and it matters for understanding the rules. SIMPLE stands for Savings Incentive, Match Plan for Employees. It was designed specifically for small businesses with 100 or fewer employees. The appeal for employers is real. Less paperwork, no annual compliance testing, lower administrative cost. A traditional 401k requires non-discrimination testing every year to make sure the plan doesn't unfairly favor highly compensated employees. SIMPLE IRAs skip all of that. So from your employer's perspective, it's just easier. I don't say that critically. For a small business owner with a dozen employees, it honestly makes sense. But from your perspective as someone trying to maximize savings in a compressed timeline, the SIMPLE IRA has tighter contribution ceilings, and that gap is what we need to talk about. For 2026, the standard 401k employee contribution limit is $23,500, according to IRS guidance on Secure 2.0 adjustments. On top of that, if you're 50 or older but haven't yet turned 60, the standard catch-up contribution adds $7,500, bringing your total to $31,000. That's the number most people find when they search. Now here's where the SIMPLE IRA diverges sharply. The 2026 SIMPLE IRA base contribution limit is $16,500. That's the employee elective deferral ceiling, not the catch-up. The standard SIMPLE IRA catch-up for people aged 50 to 59 is $3,500, giving you a combined ceiling of $20,000. Compare that to the $31,000 available in a 401k, and you're looking at an $11,000 annual gap. Over 10 years, assuming even modest growth, that difference compounds into a number that should get your attention. Now, I want to be honest here. For a lot of people in their early 50s working at small businesses, hitting $20,000 a year is already a stretch. The limits aren't always the binding constraint. But if you're in a position where you can max out, maybe a second income in the household, maybe kids are finally off the payroll, then understanding the ceiling matters a lot. Your individual situation, your tax bracket, your other income sources all change how much of this you can realistically deploy. But you can't use a higher limit you don't know exists. So let's talk about the 60 to 63 super catch-up, because this is the piece of Secure 2.0 that almost nobody has connected back to SIMPLE IRA holders. Starting in 2025 and continuing through 2026, the law created a special elevated catch-up for people who are specifically aged 60, 61, 62, or 63. Not 64, not 59, just those 4 years. For 401k participants, the super catch-up is $11,250 in 2026, rather than the standard $7,500. That pushes the 401k total to $34,750 for that age band. For SIMPLE IRA holders in the same 60 to 63 window, the super catch-up is the greater of $5,000 or 110% of the 2025 SIMPLE catch-up limit, which the IRS has set at $5,250 for 2026. So your total SIMPLE IRA contribution ceiling at age 60 through 63 becomes $21,750. That's better than the standard $20,000, but it's still roughly $13,000 below what a 401k participant in the same age band can contribute. I want to be direct about this. If you are 60, 61, 62, or 63 right now, and your employer offers a SIMPLE IRA, you should be using that super catch-up. Don't wait to see if it applies to you. Go look at your plan documents today and confirm the provision is there. One thing I hear a lot, and I want to address it plainly. People assume Secure 2.0's Super Catch-Up is automatically turned on in every plan. It isn't. The employer has to adopt the relevant plan provisions. For 401k plans, most large providers have already updated their documents. For simple IRAs held at smaller custodians, it's worth a direct conversation with your HR contact or plan administrator to confirm the Super Catch-Up is available. I've seen people assume the upgrade happened automatically, contribute only the standard amount, and miss months of accelerated savings. Don't let that be you. Now, and this is the scenario that trips people up more than any other. What happens if you change jobs mid-year? Say it's 2026, you're 57, and you spend the first 6 months of the year contributing to a simple IRA at a small employer. Then you land a new job at a larger company that sponsors a 401k. You've already put in $10,000 to the simple IRA. How much can you put into the 401k for the rest of the year? Here's what the IRS rules actually say, and this is important. Simple IRA deferrals and 401k deferrals are aggregated when it comes to the annual elective deferral limit. The 2026 combined elective deferral ceiling across all plans is $23,500 for most people under 50, or $31,000 if you're 50 or older with the standard catch-up. The $10,000 you already deferred into the simple IRA counts toward that combined limit. So you'd have $21,000 left in 401k room if you're in the standard catch-up band. The math isn't complicated, but it does require you to actually track both accounts because your new 401k provider has no idea what you contributed to the simple IRA at your old job. That's on you to monitor. Excess deferrals, meaning you overcontributed across both plans, have to be corrected by April 15th of the following year, or you'll pay income tax on the excess twice. That's the kind of paperwork headache that's entirely avoidable if you just do the accounting up front. There's a 2-year rule attached to simple IRAs that also affects the job change calculation, and I want to make sure you know about it. If you roll money out of a simple IRA before you've participated in that plan for at least 2 years, the rollover has to go into another simple IRA. After 2 years of participation, you can roll it into a traditional IRA or a 401k. This matters if you're mid-job change and thinking about consolidating accounts. The 2-year clock starts on the date your employer first deposited contributions into your simple IRA, not the date you enrolled, not your hire date, the first contribution date. If you're not sure when that was, call the custodian and ask. It's a simple question, and the answer changes whether you can roll those funds directly into your new employer's 401k or whether you need to park them in another simple IRA first. My take on the rollover question is this. Once you've cleared the 2-year window, consolidating into a 401k or a traditional IRA is usually the right move, especially if the simple IRA at your old employer had limited investment options or higher expense ratios. I've worked with people 50 and over who are planning their retirement and discover that the simple IRA their employer set up years ago is sitting in a high-fee insurance product they never examined. That erosion is quiet and relentless. An expense ratio difference of even 0.5% annually compounds into tens of thousands of dollars over a decade. The rollover itself doesn't trigger taxes if done correctly as a direct rollover, so there's no reason to leave inefficient money sitting idle just because it feels like a hassle. Now let me pull back and give you the full picture because I want to be honest about what the simple IRA does well. It's not all bad news. The employer match requirement for a simple IRA is actually more generous than what many small 401k plans offer in practice. The IRS requires simple IRA employers to either match employee contributions dollar for dollar up to 3% of compensation or contribute a flat 2% of compensation for all eligible employees, regardless of whether the employee contributes at all. That mandatory 2% non-elective contribution is genuinely valuable if your employer chooses it. You get something, even if you contribute nothing, which is not a feature 401k plans are required to offer. Some 401k plans have no match at all. So before you decide the simple IRA is a second-tier plan, run the actual math with your specific employer match included. In some situations, the simple IRA with a strong match beats a bare-bones 401k, even accounting for the lower contribution ceiling. That depends entirely on your salary, your employer's match formula, and how many years you have left to contribute. The core decision most late starters face is simply this. Am I contributing the maximum my plan allows? And do I actually know what that maximum is? A surprising number of people don't. According to Vanguard's 2024 How America Saves report, only about 14% of 401k participants contributed the maximum allowed in their plan. For simple IRA participants, comparable data is harder to find. These plans are often at smaller employers without the same tracking infrastructure, but there's no reason to assume the rate is higher. The limit only helps you if you know it and use it. So here's where I land on all of this. If you're in a simple IRA and you're between 50 and 59, your 2026 catch-up limit is $3,500 on top of $16,500, not $7,500. If you're between 60 and 63, that catch-up bumps to $5,250, and you should be using it. If you change jobs this year, track your combined deferrals across both plans. If you've passed the 2-year mark in your simple IRA, evaluate whether consolidating into a more efficient account makes sense. And if you're sitting in a high-fee simple IRA that your employer set up 10 years ago and nobody's looked at since, that's the first thing worth examining, not the last. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this helped you understand where you actually stand, hit subscribe so you don't miss the next one. And if there's a specific retirement question you've been carrying around, a Roth conversion question, a Social Security timing question, something about your specific plan type, drop it in the comments. I read them, and I'll work the good ones into upcoming videos. There's no shortage of things in this space that need a plain English explanation.